This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers security through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 102.5 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans. Or you can talk to him right now at 407-916-5400.
Another week, another 500 points on the Dow. Beware the math, and you got to beware volatility. Good morning. This is Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents here on News Radio 102.5 WFLA. We are a live call-in radio program. I remarked last week when we had a couple of callers that sometimes I get off on my monologue and don't give out the numbers enough. So I'm trying to be, I guess, is that a New Year's resolution, dare I say? Yeah, we'll make it one. So the numbers to call on in and be a part of the show: 407-916-5400, 1-855-545-1025. I guess I don't give out the numbers all that often because I don't want to sound desperate. You go around and start giving out your number to every gal in town, and you're just going to look desperate. Speaking of gals and gals in town, there is one, and my most favorite gal, of course, my wife Stephanie, turning a milestone age. We'll leave that off air as to what that milestone might be, but milestone age for Stephanie. We threw a little party last night. Good fun. Probably woke up the latest that I've woken up and still made it to the radio show live. So, yay me. Anyway, one of the comments that we made or that we will be making, I wrote the letter, but it's getting copied over the weekend and be mailed on Monday. So our January beginning of the year letter that we mail out to our clients is going out on Tuesday or Wednesday of next week. So folks should have it in their mailbox by middle part of next week, and it's still in fact due a mailing using the U.S. Postal Service. I know, shocking. We also do a lot of emails too, because of course emails are much faster to disseminate, particularly as headlines warrant. But in the letter, of course, we talk a little bit about volatility and remind folks that volatility is, in fact, quite normal and something that is a part of the markets, but certainly something that should not throw us off of our long-term strategy. And as we point out in the article, and we talked about this, I think, last week or the week before on the show, 2017 was a relatively smooth year in terms of market performance. It actually set a record for the number of consecutive months that were positive. And the market was positive every single month during the course of the calendar year. And so that actually was a year that did not have a lot of volatility. And if you look historically at the markets, you see that volatility, and as measured by declines, is relatively a normal part of being an equity investor. And of course, it's that same volatility that sort of throws people off their long-term investment track. But if you look historically, you'll find that on average, during the course of any year, you will see 3 times where the market has declined by at least 5%. And if you go a year where that hasn't happened, well, you would start to say, well, being normal part of the market, and the fact of the matter is that volatility did not disappear. We don't all of a sudden have a stock market where there's no volatility. Of course, there's going to be volatility in it, and so to just be aware of that, and to be mindful of that, and to maintain perspective on that, because as sure as I'm sitting here, the media is going to take any decline at this. They're desperate. Look, the media loves a train wreck. They love a bad story. They are desperate for the market to go down so that they can start trotting out all the worst case scenarios and go into the corners of our mind to play on our most greatest fears. They're desperate for it. So any decline, any decline, okay, is going to be made out by the financial media as 2008 all over again, as just, cataclysm. Here we go. Okay, we told you it was going to end. We said it was too good to be true, and all that. Well, the reality is that, here's where you kind of have to watch the math. Because, yes, 500 points is a lot, and that's what the market went up by just last week, and the week before, for that matter. But the math is a little different, right? Because if the Dow's at 25,000, it goes up 500 points, then that's not the same as when the Dow's at 10,000 and it moves by 500 points, right? I mean, that's you've got the pure math sort of that comes into the equation. So when the market goes down 1,000 points, we'll call it, at this level, that would be a 4% decline. It's basically what's already happened. 4% increase is what's already happened so far this year. So again, to put it into perspective, be careful of the math, because at these levels, mathematically, a 1,000-point drop, which would be a headline event, and of course it's going to be a headline event when those things happen, is going to be not nearly the same mathematical effect. So beware the math and maintain perspective, and that was sort of the message that we were giving in our January or beginning of the year mailing that will go out to our clients next week. And obviously, we still expect the year to be a very positive year at this point. These earnings that have started, which help propel the markets a bit more last week, because you had some of the companies starting to announce at the end of last week, are pretty strong. And there's a lot of conversation now as people start to work through these tax laws and these tax changes. Remember, okay, this thing happened this whole tax change happened just before the Christmas break, right? So you figure 2 weeks, people aren't really doing a whole lot, and so now they're getting back in their office. They've been back into their office for maybe a week, okay, and they've really started to look and analyze this thing. And the commentary that CEOs are providing these days about the effect of the corporate tax cut is pretty dramatic, and they expect it to flow, particularly in the case of some comment that J.P. Morgan CEO Jamie Dimon made last week. It's going to go directly to the bottom line. Well, if something goes directly to a bottom line, you're a publicly traded company, or any company for that matter, then that means that your profit is going to go up. directly proportional to that tax cut. So, it's earnings season. And as this tax cut works its way through and people start to look at it and start to kind of try and see, okay, what are the changes that are going to affect us, that certainly is something that I think you're going to see be a theme as we go forward here in earnings season. So stay tuned on that because the next few weeks will be pretty important as companies work through the earnings season. But certainly so far, a great start. And we are no different than anybody else because we now are, spent more time looking at the tax law and have spent some time trying to discern what are the important headlines of it, if you will. And so in our client letter that's going out next week, we also, of course, have our top 10 tax changes for 2018. So we've had the opportunity to kind of really sit down even more and write up a little document that describes those biggest tax changes for 2018 and what the implications are for all Americans. So I want to talk a little bit more about that top 10 list, kind of tease it a little bit for our clients. You'll be getting a copy here in a few days, and for others that are interested, we'll probably put it up on our LinkedIn page and then link it over to Facebook and Twitter and stuff like that, and on our website at nelsonfinancialplanning.com. So you'll have an opportunity to look at it as well. But we'll talk more about that. We'll slide to the break. We've got open lines. My New Year's resolution, 407-916-5400. Toll free, 1-855-545-1025. Those are the numbers to call on in and be a part of the program here on Dollars and Cents with Joel Garris of Nelson Financial Planning here on News Radio 102.5 WFLA.
You can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Well, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. This is your host, Joel Garris of Nelson Financial Planning. And the numbers to call in and be a part of the program, 407-916-5400, 1-855-545-1025. And then, of course, you can always send us an email. That email is my first name, Joel, Joel, at nelsonfinancialplanning.com. So that's how you can get in touch with us and engage in the conversation. Speaking of taxes, had the opportunity to have a lively conversation with our good folks at a competing radio station, actually, over there on 90.7, which is the National Public Radio Station. Good folks over there had an opportunity to sit down with their news director, Catherine, on Thursday and really engage in a pretty wide-ranging interview and conversation about the tax law and the tax changes. And obviously, as we mentioned, we've finished our top 10 list. It's funny, we used to do top 10 tax change lists every single year, and then last year we didn't because there really wasn't any changes. And then all of a sudden now we've got much to write about. So I always try and consolidate it in kind of a one-page, back and front kind of thing. So the back and front, it was hard to get all on one page this year because there was certainly a lot of changes to it. But in terms of what folks should be doing or what folks should be thinking about, because remember, your 17 taxes, which is the one that's coming up that you got to do. There's really not any changes, right? Because the taxes you're filing now are based upon the tax law that was in existence for 2017. So there's not much movement, if you will. These tax changes are for this calendar year 2018, so you will not see them ripple through on a tax return until a year from now. So, but that's a whole year from now. So, what are some of the things that you want to be looking at or thinking about now? And I think it really boils down to a couple of different points, which is that, and we've yet to see these, and hopefully in a month or so we'll see these, where you have as an employee, you have your withholding schedule, right? And so the withholding schedule is a schedule that is given to employers to determine, based upon what you have selected as your withholding options, that that the right amount is withheld on your paycheck. And so those tables are going to be changing in light of these new tax rates and tax brackets, but that hasn't happened yet. And so we at the office, we're waiting for those just like every other employer. And when that comes true, then we'll be able to adjust the amount of tax withheld on our employee paychecks. And what that will effectively cause happen is that the amount of those paychecks that you actually get, the cash in hand, is going to go up, because as the tax brackets have all shifted downward, then that means that you don't have to send the government as much money. So I would approximate it to be about a 3% change in your net paycheck. So that's great, right? Because now my paycheck, for no other reason except that the tax rates are changing, now is going to go up by 3%. So that's cool. Let me give you some advice. If you are working, you want to take that 3% and pretend it didn't actually happen. And instead, you want to be boosting your contributions to your employer-sponsored plan, whether it's a 403B, a 457, or 401k. Okay, look, this is important. The 3% go in at the end of February, and I guess 99.9% of those types of plans are all, probably online type platforms. Increase the contribution that you're making by 3%. It's that's what you got to do. Increase it by 3%, because your net pay is now going to be increasing by 3%. Increase your contributions by 3%. So you'll still have the same net paycheck as what you've been having here in January. And now you're able to save much more for retirement. Similarly, if you are retired, take a look at the amount of tax withholding that you're doing. Maybe your tax withholding on your Social Security. Maybe your tax withholding on withdrawals out of your retirement accounts. If you are there, that's not going to adjust automatically. It's not going to adjust automatically. As an employee, if you're still working, it's going to adjust automatically based upon the IRS adjusting the tax withholding tables. But if you're retired, those numbers don't change automatically. So what you want to be doing is looking at your tax withholding and adjust. You've got to go and self-adjust that number. So if you're withholding at 25%, you can withhold at 22%, because the 25% bracket is basically a 22% bracket. So adjust that. And one of two things are going to be able to happen. Number one, you just got a 3% raise. Now, as opposed to those working stiffs that haven't retired yet, and you're sitting retired, then guess what? You get an extra 3%. Have fun with it. Or if you say, well, you know what, I'm kind of got everything I need. Congratulations, by the way. Then reduce down how much you're taking out. Reduce down how much you're taking out and leave more to continue to grow and compound in your accounts. So very important, probably the most important concept to take away from these tax changes is the withholding and how much that is going to make a difference and what to do with it. Because there's a real opportunity for those that are working to increase the amount that they're... Look, it doesn't matter whether your salary went up this year over last year or not. It's going to go up by 3% because of the tax withholding. Take that 3%, no excuses. Take that 3%, boost up the contribution that you're putting into your employer plan. If you're retired, take a look at how much what rate you're withholding at. If you're withholding at 25, I'd drop it down to 22. There's no reason to be taking more money out of your account, right? Sending it off to the IRS and waiting a year to then get your money back. That doesn't make sense, right? So take a look at that. The other important item to look at is as you look at 2017 tax return and kind of trying to look ahead to 2018, the other item to really pay particular attention is what the total amount of your itemized deductions are. Look, the standard deduction is going up to $24,000, right? If you're over age 65, your standard deduction actually becomes $26,600 because they give you an extra $1,300 per person if you're over 65. So times 2, married couple, that gets you up to $26,600 as your standard deduction. If your itemized deductions are $15,000, you're able to itemize now, but you're nowhere near close to what the standard deduction is going to be for next year. So the good news on that, and this is the simplification part of these tax changes, is that you don't have to do that homework or keep track of all that stuff that you did because you just you're not going to be close. You're just going to take the standard deduction. So the good news is you've got less homework to do during the course of the year in terms of keeping track and organizing that, particularly if you are not really close to that standard deduction. So take a look at your itemized deductions. If you're 17, 18, 19,000 and the standard deduction is going to go up to 26,600 for you, I just wouldn't bother to do that. To do that extra homework, unless again you've got something unique that's going to happen during the course of the year. But I just wouldn't bother to be doing that homework along the way because you're ultimately going to go and take a standard deduction anyway. So those are some of the many things that we talk about in our top 10 tax changes. A lot of the other stuff we've certainly talked about initially on the program. Things like the estate tax exemption that's going up. Things like the preservation of the long-term capital gains and dividend tax rates, and a lot of the other tax changes that we've talked about in the past. So we've kind of summarized them in a 2-page sheet. So if you're a client of the firm, look for that in the mail next week. And if you're not, then first of all, why aren't you? And number 2, it's out there on the social media. We'll post it up on Tuesday, because Monday we're not in the office because it's Martin Luther King holiday, so the markets are closed, and so we are actually not in the office tomorrow because of the MLK holiday. So it'll be Tuesday when all this stuff posts on up. Anyway, we're going to take our break at the bottom of the hour here, and the numbers to call in and be a part of the program, 407-916-5400, toll free 1-855-545-1025, or the email joel@nelsonfinancialplanning.com. We'll be back right after these words.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents. This is Joel Garris, Nelson Financial Planning, here on News Radio 102.5 WFLA. The numbers to call on in and be a part of the program, 407-916-5400. Toll free, 1-855-545-1025. And then, of course, if you want to send us a text, which I guess is this screen over here, it's like two screens in front of me, you can text to 23680. And in case you have no idea how a cell phone works, or how the cell phone billing works, I guess you have to say this every time you say text, right? Standard message and data rates apply. Well, no kidding, Sherlock. So the other screen is the phone screen. And then, of course, this other thing, so I got like the phone, my phone, is the email, joel@nelsonfinancialplanning.com. So that's how you can get in touch with us here on the program. This segment of the program, I want to flesh out a topic that we've started on a couple of radio programs over the course of the past month, and then we kind of get distracted or run out of time, or my ADHD kicks in, and then I'm off on something else, another tangent, if you will. Anyway, so Social Security. We talked a little bit about this in terms of the annual statement, in terms of the mailing, right? And that mailing used to be one that we were getting every single year. And then they decided to stop it, and then they brought it back, and then they only brought it back for certain people over the age of 60, and et cetera, et cetera. And now the only folks that get it mailed out, okay, are if you're over 60, and you're not collecting benefits, and most importantly, you haven't established an online account. Because once you establish an online account, one of the little fine print things, when you establish stuff online, there's all that stuff that you just click, 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 and don't bother to read. Well, one of those things that you didn't read when you click, click, click away on the Social Security website is that you basically agreed that they're not going to mail you anything. That if you want your Social Security statement, you're going to have to get it online. And what is unfortunate about this is that if you're only getting that statement mailed, if you're over age 60, I mean, there's like a generation of people that don't even know the statement exists and have never seen a statement in their lifetime. And so what the point of that statement is to make sure that the good folks in Washington have an accurate record of what your income actually is, because that kind of determines how much Social Security you're going to get. So the real reason why it mattered to get that statement along the way is that you could look at it and be like, well, wait a minute. Well, that year, okay, I had two jobs. And so, but this statement is only showing the income from one job. And I want to clarify that and make sure that Social Security's got the most accurate information. And guess what happens if you wait 20 years to check that statement? You're not going to remember. So the point of that annual statement was actually relatively valuable as an ability to double check that the information they had was accurate. Okay, because if you're just trusting the computers to connect to the computers that connect your employer's tax filings with the Social Security computers, well, I mean, I suppose that's probably accurate the vast, vast, vast majority of the time, but I might want to put an eye on it every now and then. And so if you're only looking at your Social Security statement as you approach, age 60, you're not going to remember what you did at 40. You're not. So I think it's very important that people check this, okay, on an annual basis. Sure, every couple of years. I think the notion of doing it on an annual basis is a good habit, if you will. If you say, well, I'm only going to do it every 2 or 3 years, well, forget, and 5 years rolls by, and you're like, oh, wait, I got to check that. But it's going to be incumbent upon you to establish that online account, because that's the only way. If you're under 60, that's the only way for you to be able to double check the numbers. So we want to encourage you to do that. You go to their website, it's ssa.gov, and you go through that process of establishing an online account, and then you can actually look at your statement and verify and make sure that the numbers make sense, because as the years flow by, you sort of forget, what the work situation was. So there are. That obviously is the pretty important data on there to make sure that you can double check along the way. And those of you that are listening and saying, well, you know what, by the time I get there, Social Security won't be there, we vehemently disagree with that notion. It will be there. A lot of the conversation that you hear in the media of how it's going out of broke or out of business or whatever is just, nonsense. Worst case scenario, it will only be able to pay 80% of the promised benefits over the course of the next 50 years. Well, by the way, 80% is, still monthly income that you're going to be getting in retirement. So it's important to make sure that you have the right information on that Social Security statement. Other things to look at along the way, because certainly that Social Security statement will have a projection as to what your Social Security will be in retirement. But there are some other important factors that go into that calculation, because remember, what's on that sheet, it is an estimate, and so. But you want to make sure that the information that goes into making that estimate, and ultimately the ultimate payment that you're going to get from Social Security, is in fact accurate. And the cost of living adjustments obviously swing that pretty dramatically. The statement's estimates do not reflect the future cost of living adjustments, which can obviously significantly raise the estimates. Cost of living adjustment has averaged about under 2% over the last 10 years, but over the course of the past 50 years, it's closer to 3%. So the cost of living adjustment can certainly drive that. And earnings over age 62 are generally not included in that estimate. So another thing to kind of be mindful of, let's say you're 66, you're still working, you haven't taken your Social Security, you're looking at your statement, the earnings after age 62 are not included in the estimate on that statement. Remember, these statements are just estimates. So that could skew the numbers a bit in terms of what you're looking at. When you do, in fact, apply for benefits, they'll readjust those numbers. But if you're just looking at that sheet from Social Security, that part is not on there. So some important things to kind of think about as you're looking at that Social Security earnings statement and the estimate for what your Social Security benefits would be when you retire. So some important things to think about in terms of Social Security, particularly that statement that you used to get, or that everybody used to get, but now no longer everybody gets. We'll slide to a break. We get back from the break. We've got open lines, 407-916-5400, toll free, 1-855-545-1025. Those are the numbers to call on in and be a part of the program here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. This is your host, Joel Garris of Nelson Financial Planning. And of late, we've obviously, over the past few weeks, gotten some questions on the fabulous topic of Bitcoin, which we compared to the old tulip bulb bubble in Amsterdam back in the 1500s. I think that show was probably 6 weeks ago. Remember, all these shows are out there on our website, NelsonFinancialPlanning.com, and on social media as well, Facebook, Twitter, all those places. And so if you want to ever, kind of go back and say, what was his commentary on Bitcoin, it is floating out there on the internet or in the cloud or wherever that stuff resides. One of the other questions that we get, which actually is a lot more legitimate, and that's a good word to use when you hear what I'm going to be talking about here. A little bit more legitimate, but still also generates probably a more regular question about investing, and that's the notion of investing in pot. Okay, how do I do that? What's the ramifications? Look, the reality is marijuana is legal in a number of states. California being the latest and the biggest state to sort of add it into the mix. So when you look at sort of what states have medical marijuana, what states have it legal, and have it subject to kind of almost the same types of parameters as buying alcohol in those states, and how many have eliminated jail time for possession. I mean, it's almost like a patchwork quilty type thing. And so folks ask us about, this marijuana stuff. This is, kind of interesting. And, how do I invest in it? How do I get in on it? And I think that's a great question. And we'll draw a direct contrast to underscore kind of the ridiculousness of Bitcoin, okay, versus the pot question or the marijuana question is kind of a much more interesting question. Look, Bitcoin, nothing backing it, nothing. Okay, there's nothing there. Okay, it's all just what people say that it is. Whereby with marijuana, I mean, you have a product, right? And there's a demand for that product, and you can grow that product, not just kind of make it out of the clear blue sky like you do with Bitcoin. So in terms of investing in actual investment opportunities, one, Bitcoin has nothing to show for it, nothing backing it. It's like completely made up, whereby marijuana been around for a long time, and there's a product, and it grows, and you sell it, and then you can grow the product again, and so on and so forth. Here's the tricky part on this, okay? So here's the answer when people ask me this question, is it is a patchwork of regulation, and federal law still applies. So it's very tricky for folks from an investing perspective, and similarly, it's very tricky for folks that are in the business. We've got a couple of clients that are out west, and where the regulations are very different than here, and so they have certainly shared with me the struggles that they have in terms of what to do, from a business perspective. You can't do the normal stuff that you would be able to do that you would think, oh, I can do this, automatically, because it is under federal law still an illegal drug, along with, heroin or cocaine, it's still, federal law still treats it as an illegal drug. So that creates a lot of issues involving the ability of it to be transported across state lines. It involves a significant issue in terms of banking, whereby banks are regulated by the federal banking system. So when I talk to somebody in Colorado that is involved in growing operations, he tells me, I want to invest money with you, Joel. He's got, he's had an account with us for a long time. He said, I want to add to it, but I can't. Can I bring you cash? And I'm like, no, you can't bring me cash. It doesn't work that way. Okay. There's no way you can show up in this office with a suitcase full of cash and ask to, invest in a mutual fund. It's not going to happen. And that's the problem, because the banking system is still governed on a federal level. The states don't govern the banking system. The federal government does. And the federal government still treats marijuana as an illegal drug. So this guy has a ton of cash and can't really do anything with it. Now, what's the problem with that? When you've got a ton of cash, it's very hard to keep track of it, very hard to trace it, very hard to figure out as an outside investor what actually is going on in that business, in that company, because you just don't have the same rules on it. You don't have the same ability to get that. How are you going to get a dividend on that? You're going to travel to Colorado and pick up your suitcase full of cash and then travel back to Florida? There's a lot of logistics problems involved. Here's, though, where we see this, and we've talked to certainly various investment folks, and where we see this is that ultimately you're going to have the federal government step in and regulate this as a product, much like alcohol, much like tobacco. Okay, that's ultimately, I think, where this is going as more and more states adopt rules that are happening on the state level. When that happens, I am told that there are a number of companies that are, first of all, actively lobbying for that regulatory oversight. Then it becomes a product similar to tobacco, and it's subject to the same regulations. And ultimately, I think that's where the real investing opportunities will start to open up. Very hard to take advantage of the investing opportunity, given the logistics issues that are present, because the federal government still views it as an illegal substance, which then has a massive ripple effect involving the banking system and those kinds of rules. So something to think about. I'm sure we'll be talking more about that one in the future. In the meantime, we got to wrap it up and get out of here. So have a great Sunday. You've been listening to Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio 102.5 WFLA. Are your investments the right ones to meet your goals? The right allocation can make the difference between staying retired or going back to work. At Nelson Financial Planning, we take the time to get to know you and your family to develop a personally tailored financial plan. Our approach focuses on achieving your goals rather than just checking boxes on a survey. This is Joel Garris, and I invite you to discuss your financial goals with me. Visit NelsonFinancialPlanning.com or call 407-629-6477 to set up a conversation to develop a real plan to meet your financial goals. That's NelsonFinancialPlanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC at FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 102.5 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.